So this is our fund secondaries panel, and it is actually now the 8th consecutive year in running that we're doing this secondary panel. It's maybe one word that I always say at the very beginning. In some of the sessions before, people were always talking about secondaries. That's the M&A guys, and they mean a sale from a portfolio company to another financial buyer, another private equity firm. This is not what we mean here in this shop. That's why we call it fund secondaries. We mean somebody is selling an interest in a fund. So this time we picked the topic GP-led transactions, and I will say a few things about this in a moment, but let me introduce also my fellow co-moderator. And for those of you who have been here for this panel over all these years, they will think this Amos Veit guy, he looks a little bit different this year. So it's actually not Amos Veit. Amos Veit chose to go on vacation this year. So it's our colleague Stefan. Stefan Schade is a counsel in our Berlin office, working in the funds team, covering the whole spectrum, the GP side, fundraising, fund structuring, the LP side, both primary investments and secondary investments. And now, given our topic, this expertise is quite welcome because you know both sides, and in a fund restructuring that we are talking about, all these elements come into play. My name is Tarek Madini. I'm a partner in the funds department as well. I'm also based in Berlin. My background is similar. I work also on the GP side and the LP side, doing normal fund investments and fund structurings, as well as secondary investments and secondary GP-led transactions. One or few sentences about the topic and a little bit the overview of how this panel will go on today. We have an hour, and we try to split it up. Roughly the first 15 to 20 minutes will give you an overview over the secondary market. It's something that we do every year, and people, I think, appreciate that they see the development from year to year in terms of pricing, trends, motivations, why are people selling, why are people buying, and the type of structures and transactions. This will cover the first 15 to 20 minutes, and we will start in a second with Emmanuel Rubin providing some numbers on the market. And then the second half, or actually the focus of the panel, will be GP-led transactions. And this is a term that came also up in some of the prior years' panels. And in fact, we actually did 2 or 3 years ago, we did a panel on fund restructurings. And the main difference is that historically, all these secondaries transactions were LP-led, led by an investor who wants to get out of a fund or out of the asset class and wants to sell his assets in private equity funds and other funds. And now we have a number of structures that are actually driven by the GPs. So where the GP says there are many reasons, whether in a tail-end fund context or otherwise, why the GP decides, I'm actually starting to provide liquidity options to my investors, and we'll talk about the motivations later on. So this is the main difference, and this is our focus today. And I will hand the word to my colleague Stefan.
Thank you, Tarek. So I would like to introduce our panelists to you now, and I will start at your left side, my right side, with Remco Hexman. He is at Collar, and Collar is a large secondary investor, so he will represent the secondary side, the secondary buyer side, most obviously. And next to him is Petra Bukovic at Pantheon. She is also working on the secondary investment team at her firm, but her firm also is engaged in primaries and co-investments and so on, and she will also add something from that perspective. Next to Tarek is Enzo Schiavello. He is a lawyer in Italy at Legans, and he's a very experienced fund lawyer in Italy, very known. And he will also add his perspective from a legal side and also from the Italian perspective, knowing that things sometimes develop differently or later in different parts of Europe and the world. Next to him is Richard Hope of Hamilton Lane. he is also working on the secondary team at his firm, and his firm, like Petra's, is also a primary investor. And next to him is Emmanuel Rubin of Campbell Lutyens, placement agent, who is currently actively involved in such GP-led transaction and advises GPs on such structures. And we are very happy to have you all here, and we look forward to a good discussion. And we will start, as Tarek mentioned, with an overview on the developments on the secondary market, and with this will be presented by Emmanuel.
Thank you. Good. So we thought, just to set a bit of scene, we'll give you some data from our buy-side survey, which sort of we did every time, like the first January, February, but it gives you a little bit of a flavor of what we see in the secondary market and why the topic of GP-leds is so interesting and so pertinent. So when you look at general volumes, what you can see is that last year we estimated about 73 billion of transactions. When you look at these volumes, what is quite interesting to see, there's the 2012-13, so we're talking about 5, 6, 7 years ago, this market was about a 30 billion market. We did see a step change to 45 to 50 billion over the next years. There was a small dip in 2016. And there's a theme around them. So 2012-13, we saw a lot of the banks still selling. The theme between 2014 and 17, which was driving growth in the industry, was really active portfolio management. And then you see this really steep increase to last year. And that has really been driven by what we would call the GP-leds. When we think about the dynamics, though, how does this compare to the dry powder? Interestingly, we've just redone our analysis, and we actually estimate there's probably nearly 200 billion of dry powder out there. That really consists of dry powder within funds, leverage that secondary funds can utilize, and we estimated about a 40%. Let my panelists comment on that if they would like. And then additional dry powder, a lot of the large secondary funds are currently fundraising, so there's still capital to be raised amongst them. What is interesting is when we would have looked at these numbers, let's say 6 months ago, 9 months ago, you would have started to see a real imbalance between the 73 billion and the dry powder. But that's where we've seen this strong fundraising coming through again to create basically 2.5 years of runway, which is about the average that we have seen over many years in the secondary market. When we look at the activity by transaction type, so Tarek already introduced, the market is still dominated, and the largest part of it is still what we call the LP-led. So these are the investors actively managing their portfolios. And it's still growing. So it's not just that this market is sort of stagnated, it's still growing, and we've seen an increase from last year from 34 to 45 billion there. But what we find fascinating is the GP-led. So if you look at 2016 here, we saw just 8 billion of transaction, and that's now at 23%. So you see a CAGR of 66%, so very strongly coming about, and there's something happening here in the industry, which we're going to be talking about today. And then larger part, actually we're a lot of growth, but coming from a very low level are sort of preferred equity transactions. They sometimes get muddled into GP-leds as well. And secondary directs, so these are really just straight portfolio sales without some of the complexities associated with GP-leds. So we'll talk more about that later. When we look at geography, the fascinating observation there is that Europe is not the best ground for secondaries. We really see it's dominated by the US. It had a bit of a dip actually in the US last year. This was because we had some really large GP-leds in 2017 in Europe. We sort of rebalanced that a little bit. But you can see sort of a trend that there's less happening in Europe. Interestingly, we see more and more happening in Asia. So Asia we see quite strongly coming into this market, and you can see that it was about 11% of what we've seen in the market. We like to use this slide to get parties a little bit of an idea who's utilizing this when we're talking about GP-leds. Who are the GPs out there? And it's not too long ago you would be reading articles in the press around zombie funds. So these were managers that kind of didn't manage to raise new capital but couldn't exit the assets. And a lot of this being talked about, is the secondary market a solution for that? The reality is it wasn't. But where secondary solutions really start making a real impact is what we would call with high quality managers. So these are managers that really utilize the secondary market to achieve certain objectives around creation of liquidity. And really key names are coming into the market, and I was just joking with my panelists beforehand, probably missing a lot of logos here. There's actually quite a lot of other funds out there, particularly in the US. It's come now very, very strongly. But you will see TPG, Providence, Warburg, Oaktree, Nordic, all names that are sort of respected, who can raise billions of capital, utilizing this market. So it has really become a market utilized by some of the top GPs in the world for that. One of the reasons why this has been happening is that fund structures themselves are really old and not a lot of innovation has happened. So when you look at a typical LP structure today, it's 20, 25 years old, and not a lot has happened. Yes, you negotiate terms, and depending on where we are in the cycle, they may be a little bit more GP-friendly. Sometimes in a down cycle, they may be more LP-friendly, but fundamentally, they haven't changed. And what this market's really been doing is actually breaking some of this up, because it's not always fit for purpose, and that's where a lot of secondary solutions have come into the market.
And maybe one sentence, if you go back, because you're a very humble guy, Emmanuel. But if people wonder, why Emmanuel is here on this panel, is that you see actually there is a little dotted lines around certain names, and this is actually the transactions that Kemper-Lutyens, and actually Emmanuel worked on many of those, was involved in. So you can see that basically the market leader in GP-led financial advisory here on the panel.
Yeah, I didn't pay him for that, so thank you.
That was the advert, however.
Yeah. The last slide on GP-led, it sort of gives you a sense again. The one statistic I find quite interesting here is the 31%. Like you can see, it's not just an increase; it's becoming more and more important to the likes of Collar, Pantheon, and Hamilton Lane here on the panel as well. This market and what's happening within that. I wouldn't explain too much at the moment what the different types are, but just keep that a little bit on the back of your mind, because Tarek's going to explain a bit more around it. But it's quite equal between different transaction structures. So it's not one dominant, simple transaction that's being utilized over and over again. It's actually really trying to solve, it's smart capital, it's trying to solve for issues, and therefore we see quite a lot of different transaction structures. Over to you, Tarek.
Yes.
If I may, I'm going to jump in a second. Emmanuel at the start, I'll pass this along, give you a minute. One of the things Emmanuel started at the start with was around the market size. So last year, 73 billion market size. At Hamilton Lane, we like to put things in context. It sounds a very large number. Global NAV today for private markets, 3.5 trillion. And so if you look at the whole secondary market, it's 2% of NAV. And we find that fascinating that it's still a tiny number. So yes, the market's big. One of the questions I think at conference last year, one of the questions came, when will the market be 100 billion? I think it's going to be potentially this year. I think what we all see is huge deal volume. If I look inside our own sort of deal CRM, last year, so the 73 billion were the deals that happened. Last year, we saw about 100 billion of deal flow. So clearly, not all deals happen in the year. Some don't happen. This year, through the first half, we've seen 80 billion of deal flow. 6 months, 80 billion. 12 months last year, 100 billion. And so if you go to the context of it's 2% of the market, it's got significant scope to grow, but also there's a lot that's driving that. And so huge additional LP volume, but also huge additional GP volume. And obviously, that's what we're here today to talk about.
I think it's a fantastic point. I mean, these numbers are sometimes, they look, like tremendous growth, but there's actually the potential is much greater. And if you see also what Emmanuel showed, the dry powder there, it is quite interesting that potentially this could all be even bigger. And before, I would say, we have a bit more slides later on. You will have all these slides for download. We should discuss the general market developments, and then later on we will focus on the GP-led, and then I will give a short introduction on the kind of transactions, what do we mean with tender offer and all these kind of things.
Yeah, sure. Shall I?
Yeah.
Can you switch to the slide with the structures? Oh. You got the... No,
I think...
you wanted to...
Yes. Should we... I think for the moment, we just start with the general market observations. I mean, we will focus on GP-led, but
So you do not want to start? Okay. Okay. So generally, what types of transactions do we have? We have rather simple ones where basically a large buyer says, oh, there's a fund where the limited partners are a little bit fatigued, and such a secondary buyer could offer all those limited partners to take over their stakes. That would be a simple tender offer. It's rather simple to structure that. What may happen in these kind of transactions is that the secondary buyer would, of course, speak with the GP, because he will try to get a large stake in the fund, and also requires the consent of the GP to acquire that. And that's why the secondary buyer and the GP will always sit together, and perhaps they will also start negotiating about terms. And sometimes it's difficult to implement these terms because you cannot change the existing LPA. So you need to think of structures how to do that. That's where the lawyers jump in. But from a commercial perspective, the idea is to approach a GP that has LPs which are a bit fatigued, in a way to help that GP to offer a liquidity option, and to build a new relationship with such a GP. And that's obviously the way it started. Another type would be where a secondary buyer is mainly interested in single assets that a fund holds. And there may be different reasons for that. One reason may be that the fund is at the end of its term and has spent all of its commitment, has deployed all capital commitments, and is simply out of cash. And the question is, where does the new cash come from? The investment is still not ready for a full sale, but it needs a bit more financing or a bit more time. Both things can happen. And what you try to do then is to find new financing. And one way would be to open an annex fund. We have seen that after the financial crisis a lot of times. And you always offer that only to the existing limited partners, so that they would not get diluted. They have their chance to maintain their interest. But what is new now is that such offers are also made to secondary investors who deploy more money into that. And that's really where it gets complicated, where you need to talk about valuation, not diluting the old investors too much. Sometimes the old investors would want to take part in the new financing, they want to roll over. And these are the kind of transactions which are really tailor-made, and which we see now very, very often, I would say. Yeah. So focus is on particular portfolio investments, single assets, a group of assets. That's basically what we see currently.
I think for the moment that's enough. We will, as a general overview, that you have these two types of transactions: the tender offer, which is like a normal LP transaction. Somebody wants to get out of the fund, but the offer is not to one LP; it's going to everybody, and everybody can potentially sign up for it. And there's usually not much of a change in the structure, or the more complex situations that we will talk about a little bit later on. So I think we should focus now a few moments on the general secondary market, other than GP-led. Maybe we start with Remco. What are your general observations when you look at the last 12 to 18 months in the, obviously the GP-led, we learned, is a big part of it, but there are still portfolio transactions going on that are not GP-led.
That's true. Yeah. So I echo what Richard was saying earlier. We see such strong growth in the market. The traditional business, or what we would call maybe plain vanilla business, is going ever so strongly. You saw the growth numbers in the graphs, and then the GP-led is just rising at such an incredible pace, which I think is very interesting and makes me. It mirrors to a large extent how traditional secondaries developed 15 years ago. 15 years ago, if you called up your GP and said, I want to sell my position in your fund, the GP often got worried that it would be a bad reflection on his business. that has completely moved into the mainstream. No one's worried about that anymore. Everyone accepts the secondary market, and in particular the plain vanilla market, completely as a portfolio management tool. And the GP-led side is going through that as well. I think the slide with all the GP names that have utilized that stress that point even more. That is really moving into the mainstream. So that is where the biggest growth is coming from. And then it shows up in all sorts and shapes. So we've done tenders ourselves, we've done continuation funds, and one particular trend that we see a lot that was just highlighted is single asset GP-leds. And GP motivations is really what drives that. So sometimes maybe it's not quite the right time to sell it yet, but what we more often see is GPs own an asset that they really like, it's growing strongly, they don't really want to say goodbye to it. And so they're just going to find a way to hold on to it, because you could sell it and move on, and then your competitor maybe will end up buying it and make a good return on it. So a lot of GPs, when they have trophy assets, they decide let's not sell to a strategic or to a competitor, but let's find a way to hold on to it and to continue to manage that asset. And from the point of view of a secondary buyer, that can be really interesting, because we're all about aligning ourselves with GPs, and in those situations, we can feel that we are aligned. So I think that are some of the trends that we see, and the most notable one in recent times has been the advent of the single asset GP-led one.
Yeah, maybe just a couple of points to add on the traditional side. What we've seen, and Emmanuel and Remco talked about it, is portfolio management, selling for portfolio management. We see a lot of pension funds selling, they have 100, 150 names in their portfolio, and they're pruning their portfolios, only focusing on core GPs, maybe portfolios 20, 25. Funds GPs, because that is manageable for the team sizes they have. So we see good quality funds being sold on the market. And the other growth trend on the LP side is tail ends. Us, as well as our competitors, we get pressure from our investors aiming to finalize, terminate the fund. So there is a lot of growth also being driven by funds selling their tail end positions, to terminate the funds that are, 12, 13 years old.
I think it's a very good point that though we have the secondary buyers here on the panel, but they are also sellers sometimes in their own fund of funds, and so both sides. Yeah.
Yeah, no, there has been a lot of, and probably Emmanuel has better numbers than I do, what proportion of the LP market is driven by fund of funds selling, but I would say probably up to a third, if not more, is tail end positions that fund of funds are selling.
I would certainly second that. The interesting thing, actually, secondary funds are big sellers themselves. So there's a lot of tertiary, we call it, activity. And we did a survey, I think, probably 2 years ago, but it seemed like basically every secondary fund has utilized the second market themselves, which is very interesting.
Maybe Richard?
I've covered a little bit of the market stats. I think what you're hearing here is secondary is a tool. As an LP, you can use it to optimize your portfolio. But as an LP, you can also use it in your portfolio construction to help with performance, J-curve mitigation, other reasons. So, I think there's many different reasons. As we look, so we're one of the largest allocators of capital globally, about $30 billion annually sort of committed on the primary side. So, big new fund investor, and work with many of the large sovereigns, corporates, endowments, pension funds. One of the things that we generally see as a rule is the buzz a few years ago was to do with doing more with less, so reduce your number of managers. Petra mentioned 20, 25 managers, pick how many it is that you want to be with. The challenge has been most LPs have struggled to get more money with the same GP. And so huge pressure in terms of upping your commitments with your known and trusted GPs. So what that's mean is those over-diversified portfolios have continued to be over-diversified. And so as we think about the volume here and the volume that's happening, we continue to see portfolio sales because the tail has just got too unwieldy. So the majority of the performance has come through for the existing LP. The incremental the incremental return, so on an IRR basis, is dilutive. For the secondary buyer, it's still a new good deal with some IRR upside, but because most of the IRR is baked for that primary investor, then they're often looking to move that on into a new position. So, I think the market is big. Does it feel unwieldy? No. We still see a ton of growth, and there's lots of factors that are driving that.
Very interesting. I mean, one thing is that we always see it's a lot of activity in the US and also a lot of activity based from firms based in London. But to diversify the panel, we also have not only our colleagues here from Germany, but also Enzo, who has a continental European perspective on it. And maybe you can say a few things about what you see in the Italian market. There are some very established private equity firms, family offices also on the investor side, and other institutional investors, banks.
Yeah, this is an active market also in Italy. I think most of the transactions we have seen so far relate to banks wanting to just divest their private equity arms and the private equity investments, and so that starts from the banks or the private equity arms for the banks. But we're also seeing more traditional transactions, for instance, GPs wanting to just exit a line of business and just wanted to say, in the recent transaction, I mean, this is published by Fondo Italiano, di Investimento, they wanted to just close their line of business in direct minority investments, and they wanted to provide liquidity to their investors so that the investors could invest into new funds. And so that was one of the motivation, and that was a 300 million euro transaction. Another reference transaction that we have seen was F2I, a large infrastructure fund. They merged the assets, basically the first fund. So the assets remaining in the first fund, infrastructure fund, into the third fund, while raising funds for the third fund at the same time. So that was I would say, sort of a fund restructuring coupled with a primary commitment get by investors. And we've also seen transactions covering managers of indirect funds. For instance, Advanced Capital was recently sold to Montana. And I mean, the company itself and the investments into their second fund was sold to the same buyer. So we see a number of these transactions, and we see a number of actors which are very active in the market.
Very interesting. And you also mentioned the point that nowadays you often have secondary transactions have a primary element to it. Yes. These so-called staple transactions. Maybe Emmanuel can say a few things about how that is going on, and it creates some issues also, but also some opportunities.
Yeah. If we're starting with controversies in the market, it's what they're talking about. Staple transaction is really where the GP asks for new money as part of a secondary transaction. So the idea is for a secondary buyer, while they get access to the assets, and there's an argument around it, is there a cost to the secondary buyer because you're going to force him to take primary capital on it? So this is a little bit where there's sensitivity around some of the LPs, because intellectually you could argue, well, why don't they just do the primary investment on their own, right? Or and therefore it must have an impact on pricing. Now, the interesting, and maybe bringing it back to the GP-led theme here, is that that GPs can utilize the technology out there, typically because of the potential conflict that you do have here and the concern there. These transactions should really be done on an optional basis. They should typically be done on the tender format that has just been explained. It's really, you go above the fund level. You don't really go into the structure of the fund. You keep status quo, and most importantly, if an LP doesn't need to do anything, it's a service offering as such. As it relates to pricing, the thing to realize when it comes to secondary transaction is, at the end of the day, a secondary buyer, they will track them, the GP, they will try to get to the bottom of it. But at the end of the day, it's an intransparent market. if you ever look at your reports from the GPs, while some of them, they try to report a lot, but there's still a lot of questions if you had to price them at the end of the day. And I know the guys do a fabulous job there, but it's things that you just don't know, and automatically as a secondary buyer, you're going to have to use some conservatism. If you don't fully get the balance sheet of a company, you'll have to use some conservative assumptions because you don't want to get caught out with that. So what we have actually found is that if a GP is motivated by, for example, raising stable capital, they'd be far more willing to support due diligence and may actually be willing to share information they would have otherwise not necessarily shared. Importantly, this market, once you share it with your new investors, you also have to share it with your existing investors. But you create value. And the interesting thing is, I mean, it's pretty much in the press, is when we advised BC Partners where they did that. That was a fund that was basically trading at a 2.5% premium prior to the transaction, and within the transaction it was trading at a 14% premium, even though it had a stable component to it. And the simple reason for that was just the ability and willingness and motivation by the manager to help secondary buyers with their due diligence. And it was little things like capital structures, like how do you get there, better idea of how to think about certain rollout strategies. It's all the kind of things as a secondary buyer would typically not see. And therefore, while there's some controversy, I think if it's done well, if it's done on an optional basis, and if the GP is motivated to actually generate value for the LPs, you will still get better value in these stable transactions than without it.
Maybe just, if I look at the deals that we saw last year, about a third of the deals had some sort of staple component, so on the fund restructuring. So, you know, to Emmanuel's point, it is and can be somewhat controversial. And actually, I think the market in a big way has moved past staples, which is successful GPs generally don't need them. And where successful GPs have raised subsequent funds. You know, I think the zombie fund was mentioned earlier. You know, the zombie fund was the underperforming fund where it was sitting below its carry hurdle. The GP wasn't going to raise carry and frankly might not have been in a position to raise a subsequent fund. I think that's a whole different story to where we are in the market now, where successful GPs have done restructurings. You know, and so the names that Emmanuel had on the sheet there, very good, strong GPs who've raised subsequent funds. And so, you know, I think if you go back 5-6 years ago, many were trying this where there was sort of doom and despair about raising subsequent capital. So how do we find some new money to invest to keep in business? You know, I think today that's not necessarily the case. So while some are still asking, and some very good GPs are still asking for good reason, many actually just don't need to do that. And so the tender can happen in a much cleaner way, which allows kind of efficient analysis of the opportunity and pricing of that opportunity.
Well, I would like to add one thing. This must not always be the case. I mean, I've seen cases where a staple was offered simply as a liquidity option, as a favor for the investors in the old fund. So the manager said, okay, we are already well subscribed, yeah, and we want to offer the investors in the prior funds some liquidity, and the one who also takes up the old piece, gets a first draw on the new fund. So I just wanted to mention that there are many ways to play this, and this may be one other way.
And you sometimes see also staples outside fund restructurings and GP-led. So I was advising a number of transactions where a fund of fund was just buying normal LP stakes in funds, but of course the GPs want to know who's buying those because it's all about the relationship, and they ideally have an investor who has the potential for coming in for the next fund. And some of them, I think, as part of the consent given, they ask for, are you willing to a hard or soft commitment? Do we go for a stapled? And there, maybe the conflicts of interest are not as strong, but they're also there a little bit. Yeah.
Yeah, similarly, to add to that, you know, we've seen most of the staples, as Emmanuel and Richard said, alongside tender offers. We've seen that as part of the portfolios where the GPs asked for a staple in order to transfer. And also what we're seeing is GPs, especially in the mid-market side, are managing their LP bases and are being restrictive who they are allowing to transfer their interest to as well. So GPs are managing their LP bases with staples and other measures around that.
Maybe and so as a last point for this more general discussion, GP consent. That's obviously a topic that is wired in the LPAs, in the fund agreements, that the GP consent is required and that usually it is discretionary. Over the years, as people got more used to secondary transactions, people felt it was easier to get the consent. I think last year there was some discussion here on the panel that they felt some GPs are looking at it again and maybe trying to add a staple component. Do you have any observations on the GP consent?
Well, at least in Italy, we normally, in fund documentation, have provision pursuant to which the consent may not be unreasonably denied. So it is not totally discretionary. I mean, that is the starting point. Now, with respect to, say, conflicts, let me add one point. I think a key point is how to handle conflicts, because we recently had recommendations issued with respect to fund structures by ILPA, and the main concept was that, of course, conflicts must be addressed, but basically they have to be addressed by just disclosing conflicts, for instance, a staple component to the investors, to the LPs, and by, say, getting the consent to the ALPAC, the advisory committee, which is, of course, necessary. The question is that sufficient? From, I would say, a continental perspective, I would say Germany, Italy shouldn't be different, because we have a principle pursuant to which, I mean, conflicts must be identified, must be prevented or mitigated as far as possible, and, of course, managed. Now, the question is, do we mitigate or prevent conflicts by just, say, getting the consent of the ALPAC, where a transaction could be construed, but without the staple component? And that's a question that you do not have an obvious answer. We would normally make a distinction between, as Rubin will say, between LP tender offers, where normally the argument could be, has a GP a fiduciary obligation to its LPs to look for liquidity events for them and to maximize price? And probably the answer is no. And another point is this a coercive transaction? The answer is no. The final decision will be made by the LPs. So we don't see a staple component normally into an LP's tender offer like an issue. So the concept is that basically we do not need to get additional system to manage the conflict. But when you come to a fund restructuring with a staple component, the question becomes tricky. I mean, it depends on circumstances, it depends on how the transaction is built. But I would, in general, say that you cannot avoid completely a legal regulatory risk concerning the management of that conflict. And so you have to determine how big that risk is and have to take into account also how fair you've been in building the process. So, but the conflict risk cannot be totally avoided. I mean, that is our perspective.
I think it's a good point. Maybe it's an open question. Whoever feels they can say something on this topic is that on the one side, it's a legal point, how to manage these conflicts, how to do the proper disclosure. And disclosure is a lot about, getting the documents right, having as ILPA suggests, a long enough timeline, at least 30 days or 20 business days, and so getting the process right. And I think it's also where financial advisors come in very handily, because they really know how to run a smooth professional process. At the same time, besides all these legal issues, I think conflicts are also very much a business thing, because this industry private equity was really thriving because interests of both GPs and LPs are normally very much aligned. Everybody has an interest in the success of a fund. Now, these type of GP-led transactions, all of a sudden, there might be a little bit different interests. The GP may want to raise a new fund, want to have a change in the economics. The LPs maybe just want to continue as they are. On the other hand, they realize that sometimes for remaining assets, you maybe need to re-incentivize the GP. So maybe that's a point where everybody has a say, maybe how to manage this on the business side.
I was going to say that the staple really is only one manifestation of the conflicts that these GP-led situations are. And so, there's a much bigger point of, the GP is acting as both the seller and the buyer. So the conflicts are huge and massive in any situation. So it's all about not only disclosing that, but managing it. So I agree that the presence of an advisor is very useful, even though as a house, when we buy portfolios from sellers, we love to do it on a one-to-one basis. In these GP-led situations, us as a buyer, we also want an advisor present because the integrity of the process is so important. It may sound counterintuitive, but when we buy in these GP-led processes, we are really interested in having potential sellers, so the LPs in those funds under consideration, be happy with what we're proposing, because if they're not happy, we're going to have very low take-up in the transaction, so it'll be a tiny deal. But even more importantly, it will hurt our reputation, because if we do a deal where people don't trust that the process was well managed and that the conflicts were disclosed and managed well, we will never do another GP-led because people won't trust us. So reputation is such an important thing in these processes that are very difficult because of the inherent conflicts that you can't get away from.
And even more than that, right? It's private equity is a long-term industry, and if a GP is acting the way we don't want them to be acting in the process when we are buying, well, it is likely that they may act like that a few years down the road. So for us, it's important that the GP is acting, is fully disclosing the conflicts and enacting in the way, we believe is appropriate, and from both the buy and the sell side.
Perhaps this is a point in time to explain how these processes are run. I mean, usually the buyer, the secondary investor, and the GP are in contact much earlier than the LPs are being informed, and they have months in advance of structuring, of discussing, of valuing the assets and so on, and often the LPs have like a couple of weeks after you had a couple of months of structuring this. So I just wanted to mention that to the audience.
Sometimes it looks like that, but we always encourage GPs to discuss a potential liquidity offering with at least the advisory board, but ideally with the, depending on how large it is, but with the investor base. Because if you don't bring the LPs on board early on, it may not happen. And we've seen a couple of examples in the market where people were gearing up for a GP-led, and the GP probably mismanaged the communication with the LPs, and it just doesn't happen then. So we do encourage GPs to talk to LPs early on, but I think it's fair. We'll put a deal team on it for weeks or months to figure out what the assets are and to come up with an offer, and then we're going to ask the LPs to decide in 20 business days. So there is a mismatch there, which is, I think, part of the conflicts and where the advisor plays a role.
Yeah.
Yeah, I mean, I think any transaction that doesn't involve communication is destined to fail, and I think we've seen several processes where they have fallen over because the GP's frankly not talked to its LP. And so, I think to Remco's point, the secondaries sort of consideration, the secondary buyer's consideration can run many months, but there's absolutely no reason why the LPs can't be spoken about. And so, as a large investor in funds, we see this almost every day, where GPs come to us and say, I'm thinking about this, what should I do? And I say, well, be clear on the motivations, be clear on the objectives, be clear on who you're talking to in terms of the advice that you're getting, and then share some of that with your LPs. Because as LPs, we're all cynical, we're all kind of staring around the corner wondering what the GP's really cooked up with the buyer or what plan is out there. But actually, generally, they're fairly straightforward motivations and objectives. And if you have your LP on side, then you're much likely to get the transaction over the line. And so in the deals that we've been involved as an LP where we consider, and as I say, it almost happens on a daily basis, we're talking to the GP. We shouldn't be reading about it through the newspaper or the whatever email that has just hit our desks. We should have heard about it from the GP. And if you're talking to your GPs, you should know what they're thinking about their funds, particularly where their fund life's over 12 or 13 or 14 years old. Even as an LP, you should probably be suggesting some of these things to manage liquidity solutions. But as a secondary buyer, one of the things that we focus a lot around is the role of the advisory board. And so how well prepared is the GP when it goes to talk to its advisory board? We've heard the phrase conflict raised many, many times in the last 10 minutes. The role of the advisory board is obviously to consider the conflicts, potentially waive those conflicts. I've seen situations where the GP's gone to the advisory board, will you approve my deal? So, well, sorry, where is that in the LPA? why are you asking us to approve a deal? That's not our role. And so sometimes actually the GP comes particularly poorly equipped to actually ask the question of the LP. And so not only are we saying, are you talking to the LP, to the LPAC, but are you actually asking the right question of the LPAC? And so not only do you need to be prepared as a GP when you're talking to your secondary buyers and your LPs, but you also need to be very thoughtful about the advice you've taken and also the question that you're asking your advisory board. If you do that, you keep them updated, you're much more likely to get a transaction done that everybody's happy with. If there's poor communication or actually the wrong question is formed, then it becomes very difficult. You know, I think the other thing for the GP and the GP must understand is they need an LPAC that is there for them at the end of the day. Very often I've seen LPACs which could be 15 people that ultimately 4 or 5 people turn up to make the final decision because the other 10 or 2 are afraid to, from a liability perspective, to actually vote. You know, that's what's going on in these LPACs. And so, you know, if a GP is doing its job, makes the LPAC feel that they have full information, full transparency, understand what's going on, you know, the advisor has a big role there in terms of briefing the LPAC in terms of offers. Emmanuel can probably talk about this. Offers that have been received, considerations with the GP in terms of who might be an appropriate person making an offer, and then ultimately the ability to get that deal done. And so if you're spoon-feeding your LPAC all the way through, and ultimately they have to bless it, that's before, by the way, you even need to go out to the full LP vote, then you're going to be much further down the line. I've had other LPs, lawyers call me, challenging me as to why I'm choosing to vote on an LPAC. I said, well, I'm a member of an LPAC, I have a right to vote, I will therefore vote because I'm being asked to consider something. But it can become quite scary as an LP on an LPAC as these fund restructurings are going on. The tender is the straightforward one, it's much more the asset deals that are generally, there's much more discussion and sort of much elongated processes.
Just adding, I mean, I think Richard starts outlining some of the complexities that are being involved here, and clearly communication is key, but it's actually very, very complex communication because you're going to have some real challenges here, in which we call the chicken and egg. Because at the end of the day, an LPAC should really opine on the conflict. In order to opine on the conflict, you need to know the price, the conditions, you need to understand what is actually at the end there. The issue you have, you only know that at the end. So yes, you need to communicate early, you need to track it. I mean, as Richard said, spoon feeding. I mean, you need to bring them along, you need to, and I think absolutely right, commercial rationale and objectives. But at the same time, you don't actually know the answers. And even worse than this, sadly, LPACs are very leaky. Like, the sad news about our market is that every single GP-led trade ends up in the press. It always ends up in the press once the LPAC has happened.
I thought that was you that put it there, no?
No, there's no interest on our side, and neither on the buy side there's no interest for this to go in the press. It is absolutely correlated with an LPAC. I mean, it's just amazing. And therefore, you've got this issue, like how do you manage that aspect to it? Similarly, briefing them where the process is. Now, you will find that quite a few secondary buyers are on the LPAC. So can you really give them full details after phase 1 bids in terms of what's happened? No, you can't, because it's going to go to the secondary buyer, give them a competitive edge. So there's some real difficulties here with how do you actually manage communication. And then lastly, one of the core issues, we're talking about conflicts between the GP and the LP. Actually, there are conflicts between LPs. Just to give you the idea. The easy one is the secondary guy themselves. So they came in a bit later into the game. They have a different entry price. They have a different perspective on the transaction than maybe existing LPs. But not even that conflict. Where we've seen the biggest conflict is amongst existing LPs who've been there from the beginning. You'll find the ones that say, look, we don't know where to deploy capital. Oh, we love this trade because you give us another 5 years with you and another upside. Perfect, go for it. And you've got the other LP that says like, oh, I want liquidity, I want you to exit the assets, you're in year 12, what are you doing here? So you've got actually 2 LPs that want something differently. So we see that a lot when we talk to GPs, like how difficult it is to manage those 2 sides. And when we speak about LPACs, and handing back to the lawyers in a second, interestingly, the way the LPAC is structured, if Richard sits on the LPAC, the only person he's got responsibility to is himself, because that's how the indemnification typically works. It's not Hamilton Lane, it's not the existing investors, it's literally an individual. They can do what they want. And we've seen organizations where an individual sits on that, riles against the transaction, while the organization behind says, like, what a great deal. I mean, it just does not marry up, but that's the kind of things you're going to have to deal with in this type of transactions.
I mean, I think you maybe listen to all the complexity and think, why bother? I think big picture and the reason why we're here and all excited is actually it does create the opportunity to buy, hopefully, portfolio of assets that have a good, solid, go-forward story around them. And so when we're talking with the GP about these particular structures, the question we're also asking is, what is it that's for sale? What are you going to do with that if you continue to hold it? And if you apply some additional capital to it, what's the outcome likely to be? And so, big picture, that's what makes us excited. I think we all have headaches, some of us more than others, in terms of trying to get these over the line. But ultimately, they're not there to rip ordinary LPs off. They're there to give the LP a fair price in terms of the assets that have been managed for probably 12 years, 13, however long you want to say in terms of the fund life. But if the GP thinks it's 5 years that they've got to continue to hold, as an LP, do you really want to be in that fund in 18 years? And so that's the consideration that you have to make as you decide, do you roll into that new deal, or frankly, do you take the money and use that money elsewhere with your known GP?
Thank you, Richard. Really important. Why do they actually happen? Right, thank you. That's such a good question on that commercially. Often what we do find is there's maybe two key aspects to this on the commercial side. The first one is our assessment of what is secondary capital really good for? Where does it really work and where does it not work? And one of the things is Remco, Petra, Richard's skill is really assessing a portfolio through a manager, through the track record of the manager, understanding the value add. What can this manager do? What are they good at doing? And if they see a story developing here where they can actually see it's a playbook of that manager to some existing assets, they can actually start building a conviction around this. They can start actually building an investment case on their side. And that's where we've really seen where secondary capital can be very competitive. Because often these are situations where when you go into the M&A market, that's where the red pen comes in. It sounds like fantasy, some of these things. And not to say the secondary market will accept this per se, but the secondary market may be able to price something slightly differently if they got conviction around the track record and the ability of a manager to generate that. And that's where we've really seen some premium pricing out there in secondaries. This doesn't mean secondary capital is just the cost of capital is lower or they're just silly money. They're not. They've got a different skill set for the right assets. It can really work. And then lastly, what these deals do, and it shouldn't be underestimated, so I was railing around the conflict between LPs, but at the same time, it actually provides the LP an optionality, which they otherwise wouldn't have. If the assets are sold, they're gone. And actually what this does do is it provides those LPs that actually want to continue with them the opportunity to stay on.
Maybe two more points that are quite interesting, always coming up in these kind of GP-led transactions. One is maybe, it's the point of pricing, and as you said, it's a very bespoke process depending on the type of assets, and maybe that's also where the strength is from the GP buyers. But what is the role of fairness opinions? Is something that can be helpful? If the process with a lot of bids came in, is it really required? What's the expectation there on the market? What do you think?
I was going to say it's really for the LPs to get comfort that what they're getting offered from us makes sense. So we're not going to rely on a fairness opinion. We're going to do a lot of work ourselves. So we're going to make sure we understand the assets really well, and we're going to make sure that we feel we're going to be aligned with the manager. That's going to inform our price. And then, as LPs worry about what process has been followed, I think a fairness opinion can give them great comfort that they're getting a good deal or a good enough deal.
The secondary buyer is being asked to assess value, but only for them. And so the price that they bid is what they're willing to pay to own that asset. The fairness opinion is much more useful for particularly the LPAC, so the ordinary LP that may not have a valuations team, that may not have the ability to actually properly value assets. And so how do they know that the secondary buyer's bid is actually fair? I think the regulator today particularly is very interested in LPs being treated fairly. And so I think using a third party not only to run a process, but a third party also to generate a fairness opinion can be immensely helpful to those being asked to make a decision to waive a conflict.
And maybe related to the pricing, the type of due diligence that's being done, is it closer to an M&A deal? Because there are few more, there are just few assets usually, like in a tail end scenario or in a single asset sale. Is that it's a little bit different than if you buy a whole stake in a fund that still has maybe 20 portfolio companies?
Yeah, I mean, I think it's much more involved. If you're looking at, say, pick a portfolio of 4 companies, you're doing drains up analysis on all four of those companies. You're probably spending time with management. You're spending a lot of time on board materials, on strategy, on ultimately what's going to happen with that business, because you're buying a fairly material chunk of a company, you know, and ultimately it's not going to trade in the same way as the LP trade. And so, you know, I think it is a highly involved process that takes some considerable time to evaluate.
That's really a new.
Go ahead.
It's really a new aspect of the secondary market. Our market is used to valuing hugely diversified portfolios, and it's very much a cash flow game, and it's about cash flow structuring. And now that we and our peers are buying these concentrated portfolios, it is actually a different skill set. So I think the market will evolve a lot in terms of how people go about buying them, but it looks very different.
But to say that it's still, we are still buying alongside the GPs. That's why alignment is so important. We are not replacing direct GPs. We're not competing with direct GPs. We are investing alongside the GPs. We are looking that the GPs are aligned with us, and they help us get comfortable, because we will never, you know, although we do a lot more work than we do on the portfolio deals, we will, you know, we will never know the asset as well as the GP does. And that's why the alignment, the GPs actually being a buyer in the portfolio alongside us, is so important in this type of transactions.
Do you actually invite co-investors in such deals?
We have investors that invest alongside the secondary funds that will sometimes will invite to invest in it.
Yeah, some of our LPs co-invest alongside us in deals.
I was just going to say the point of alignment. So, I mean, I think to be clear there, the GP very often when these deals are happening is crystallizing a very material amount of carry. It could be tens of millions or hundreds of millions. And so to the point on alignment, one, they need to be very clear as to what carry is being realized. And then two, they need to be clear on what of proportion of that carry they're willing to invest into the new deal. And so very often we see these situations where a fund was created 10 plus years ago, only 50% of the residual team has any carry, because the other 50% have already left. And so of that 50% that's there, how much of that is being invested into the deal? And so that's a huge point, and it's a big point of discussion. If nothing's going in, I think you have to be terrified and run the other way. But the more close you get to that sort of carry that's being crystallized, I think the better that we generally all feel. It doesn't mean you don't do your diligence, but it definitely means you're much more aligned with the GP who ultimately know the asset better, investing in a meaningful way into their assets.
But this is where the balance needs to get right, because at the same time, an existing investor, what are they going to look at? Are they going to reinvest all the carried interest? And therefore, should I be worried about the valuation on this transaction? So this is really where the balance, I think, have to be right in these deals. I think the GP has to be a seller, but he also has to be buyer. And if you can get that right, that's when successful transactions happen.
So would you say that getting it right is the hardest part in kind of the economics reset, getting the alignment right?
Yeah, I mean, because, I mean, as the guys were just explaining, like, because they look at these transactions through the eyes of the GP. I mean, that's the first thing I believe you try to assess is like, is it buyer, is he seller, where is he coming from? Why is he telling me the story he is telling me? And once they get comfortable with that, that's when a transaction can happen.
Yeah, I mean, go back to motivations and objectives, which is at the start, you know, and then it's being transparent. So what are you doing with the assets? What are the assets? Can you be convinced to like them? But then the whole economic piece is how much money are they actually set to make? Are they running away to the beach, or are they actually willing to continue to work these assets on your behalf as the new owner?
Maybe, Enzo, do you have any things to add on the legal side and these kind of reset of economics or alignment?
Yeah, on the legal side, I would say one additional complexity on fund restructuring is when an asset sale is involved, is that you have to look at the LPA, whether the LPA permits GPs to force investors to make an election whether to sell or whether to roll over. Because at least in Italy, you normally don't have those provisions into the LPAs. So Eventually, in order for a transaction to be completed, you need to get the consent of a given majority of the LPs to amend the LPA. So you cannot make a transaction just by getting the approval of the LPAC. You need the LPAs to consent to the transaction by amending the fund governing documents. That is one important point. That gives also some additional layer of protection with respect to conflicts, because when you get the consent directly by a given majority of LPs, you feel a little more protected than when you just have the approval by the LPAC. But you need to do it, or you need to consider very carefully the governing documents. Perhaps an additional complexity with respect to asset sales is that you have change of control situations. You may have, say, right of first refusal involved in all the sales of the various participations into the investee companies, and in all this type of provisions have to be considered and have to be discussed perhaps with third parties in order for the transaction to be carried out. Because you don't need only the consent of your LPs, but you need the consent of third parties sometimes.
Maybe to wrap things up, I would do one more round of comments, basically, where when we look in our little glass ball, whether we see in a crystal ball, whether we see, what do you see basically in store for the secondary market and the GP-led in the next year or so? We've seen it's quite complex. I think we talk about a lot of complexities, issues, misalignment, alignments. It just shows it's a complex thing. In this complexity lies, I guess, a big chance that for the secondary buyers, not many people are actually able to do it. Yes, there are a number of very big secondary buyers, but it is the smaller buyers, they probably will not be able to run a proper process. They have advisors at hand that help, but it is not easy to handle all these things. And the deals are very much of a bespoke nature, depending on the type of assets, the situation of the GP. So that's, I think, what we learned. But when you look ahead now, maybe we start from here and then we walk through the whole panel.
Yeah, so I think we will see the size of the market in general continue to rise, and I think it will be driven to a large extent by GP-leds. I think people get more used to them. As I said earlier, it kind of looks like how the plain vanilla market looked 15 years ago. I think the GP-led space will go that way. I think as people get more used to getting these requests into their portfolio, they'll get more comfortable with processing these questions. And so I think there will always be those concerns about conflicts of interest. Are they on the right side of the table compared to where the GP sits? But as they go through more and more of these processes, I think they'll devise their own processes to deal with them, and they'll be more comfortable doing it. As you can see on that slide, almost a large majority of owners of private equity funds have had GP-led situations in their portfolio, and as that number moves up, I think people will get more comfortable with it, and it will be a permanent feature of our market.
Yeah, I agree with everything Remco said. Maybe just, where in the GP-led space where we see most of the growth to come is single asset secondaries. We've, 12, 24 months ago, there haven't been many. Now there's been, a number of them being done in the market, and I think that's where a lot of the growth is going to continue to come through.
Yeah, the first time I saw such a deal was from an investor perspective some years ago, and it was overwhelming to see what had been invented then and what was going on, and you had all these partnerships shifted and rolled out and rolled over. And it was difficult to explain all this to the LPs, and I think your observation is right. As this is happening more, and this is an obvious, reasonable option for GPs to do these kinds of transactions, LPs will get used to this as well, and this will stay.
Yeah, I don't have much to add here at this point. I think the German market has been lagging a little bit behind. There have been a few deals done. I think they also mentioned in the chart that Emmanuel prepared. They have been on the smaller end, but I think there will be more to come when I see the pipeline that we also see in our own firm.
Yeah, I think I have the same considerations that you have. I mean, the entire market is a relatively little market, so you normally don't have does not attract the interest large investors sometimes, but of course people get accustomed to these transactions, they have more knowledge, and they look for the possibilities to offer to their LPs. So I would expect the market to grow.
Yeah, for me, this becomes an accepted liquidity mechanism. I think we're well on the way to that happening. I think there's a ton more of these to come. And so LPs need to organize themselves in order to cope with that. The other thing I would say is you're going to have more entrants to the market on the buyer side. So we in this room think mostly of the conventional secondary funds. I do think you see sovereigns and other balance sheet money playing a bigger role in this, and I think that will continue, particularly as the single asset deals continue to get sort of billion plus in size.
And I think there's actually more to come, because this technology, I mean, where we see now the forefront of what's happening with GPs is looking actually from a GP's perspective, how to actively manage their underlying portfolios. And really what we start seeing is GPs looking at strip sales. Could you just sell down over a particular, for example, you're overexposed to a sector, why not sell 20% down in that exposure just to get it back into your limits? We're starting to see when they can't get the leverage they would like, could we put a bit of pref equity in there? Single assets, rather than sell the whole thing, maybe it's just half of it to create some liquidity and ride out the next sort of growth cycle within the company. So it's not just about it's 100% sales. What secondary capitalists are good about that they can take strips. It's just all about the alignment and how you generate this. And actually there's more to come as this tool also starts developing.
Which is very good news to wrap this panel up. And also for us, for next year's panel, there will be definitely new topics to talk about. Thanks a lot. Hope you enjoyed it.
Thank you.